And Jason Weisberg, Seaport Securities. You've met Jason many times. All you people out there watching, tuning every day, this is the guy you want to hear. What do you think of this market?
I think schizophrenic would be a kind word.
Yeah.
I think that it's so headline-driven, not necessarily economic data points, but it's really headline-driven. And I think that momentum players are driving the game. It's been an ongoing theme. Unfortunately, it's a monotonous theme at this point. And I think that.
But we're getting buying into it. I mean, it started with one headline yesterday that looked like the European banks were going to do a ring fence, hold the line, and guys are still buying today.
Well, and yes, and I think it's a lot of shorts that are getting squeezed a little, and I think that you see a lot of momentum buying. You don't see the long-term players jumping in head first. I mean, they're dipping their toes, but they're really not going all in.
They're not believers, in other words.
Right. Well, I think they're believers in the market long term, but I think there's so many negative overhangs on the macro negative overhangs in the market right now that we're really looking at. We need some stability long term, and the totally European situation really sorts itself out once for all. I think that'll set the tone for the long term players.
Now, as I've been talking to guys down here, one of the themes I've been hearing is value buying. Guys coming in with a shopping list saying this is cheap. Are you seeing orders like that?
Not so much. We see some, I guess, rounding up of positions, portfolio tidying, so to speak. But we're not seeing real, jumping in, buying it at these levels. We got to own them. We got to own them here.
We've got Art Hogan here. He's managing director and market strategist at Lazard Capital Markets. Welcome to the Close on Street Smart, Art. A lot of rhyming going on here. Let's talk about the headlines these days, because we just heard Jason sort of reference the fact that this has been a headline-driven market. But we always seem to either be sort of in more of a bearish sentiment mode versus a bullish sentiment mode. Lately, though, these last 2 days suggest that we're kind of seeing the glass is half full when we read the headlines. Why is that? Yeah,
well, I think you have to look at this in the context of how far we've come down, too. We've been stuck on the S&P 500. We've been stuck in a range of basically 1,100 to 1,220. And that's been the case since July. So you're right, but at this point in the range, we're more susceptible to good news than to bad news. And by that, I mean the headlines that we're talking about will probably drive markets more if we get a hint of positive news out of Europe. I know we've heard a lot of rhetoric out of Europe over the last year, but it seems like we're getting to the point where it's binary. They have to do something. They have to do it quick. They've got a payment they're going to make or not to Greece. That's coming up in October. So I think that we're getting down to the final straws where they're going to figure this out. And I think there's too many shorts in this market to not see the kind of action we've seen the last 2 days.
Hey, Art, it's Adam down here on the floor of New York. Congratulations on the new gig joining Lazard. I'm sure they miss you at Jefferies, but I got to ask you, the path of least resistance, it sounds like you're telling me, is up. If so, how much higher do we go?
Adam, I think you bring up a good point. The path of least resistance seems to be up, and I think that's because we've baked in a lot of bad news here. I think that we're more susceptible to a surprise on the positive side in the news flows. So I think that we can certainly take out the trading range highs on the S&P 500, which would mean we can go above that 1220. I think a breakout above 1220 really squeeze some shorts, back into this market and get some covering going. And even at that level, if you look at current multiples, we're extremely cheap. We're trading at 12 times last year's and 10 times next year's numbers. Even if estimates come down during the earnings reporting season, the multiples are crazy cheap here. So I think the path of least resistance is probably higher, and the news flow probably gets a bit better out of Europe.
Hey, Art, if I heard you right, I think you said up around 1220. We closed, as I look at the board, 1144. So you're talking about 6, 7, 8% move. Do you really think we can get that over the next couple of weeks?
Adam, we've done it 4 times since July. So clearly that pattern's an easy one to retrace. And with the kind of volatility we've seen, you're only talking about 2 days' work here in this marketplace. Clearly we can do that. I think earnings are going to probably be, if they get any attention at all, are going to be the driver, especially on the guidance side. But it's not going to take much good news out of Europe to push us through what has been a ceiling on this market, which is right at that 1220 level.
Hey, Art, Adam and I were doing a little screen ourselves earlier today, taking a look at different metrics on profitability and then also looking at those trading at 10 or below on PE. Now, you have a fresh money ideas list.
Right.
Tell me what metrics you're using there and what companies you came up with.
All right, so for our fresh money idea list, we came out, at a very low point in the marketplace and scanned 350 names on our research universe and decided to say, okay, at this point in time, brand new money. This is not, money that we're rotating into. These are what do we buy now and and why. We try to look at market leaders, so you've got an outsized opportunity because regardless of the opportunity in the macro economy, you are going to be the leading player here. We try to look at a low PE multiple. We try to look at some dividend yield coverage. And the most important thing, I think, is a solid balance sheet. So the sort of the debt levels being low, the ability to sort of plow through slow growth. Because what we expect in 2012 is not a double-dip recession, but one that feels like it anyway, because we're 1.5% to 2% GDP growth rates. You can't tell the difference between that and a recession. So if you can operate in a slow growth economy, I think that's one of the things that you're going to need: a solid balance sheet and leadership in your sector.
And I have a list from September 19th here. I don't know if you have something more updated or if anything's changed, because it seems like on a daily basis a lot of things are moving around. But you got McDonald's on there, Expedia and TJX companies. Maybe you can go through some of the top picks off this list.
So McDonald's, obviously, clear market share, quick serve restaurants doing very, very well. You'll notice we get a bumper report in the crop prices. We're going to see food pricing coming down. McDonald's obviously has an international opportunity, especially in some of the BRIC countries. Expedia's online travel. They've only got a 30% market share. Priceline's the leader in this. You saw Priceline really get whacked in the last month or so as some momentum money came out of that. I think Expedia is a great opportunity here. Their opportunity in online travel continues to grow. They're going to spin off a division that hasn't been factored into their numbers yet. And TJ does well. For the last 34 or 40 quarters, they haven't missed a comp number yet. They do well in a good economy and a bad economy. Right now, if Christmas shopping season doesn't go well, they're the benefit because that's more merchandise for them to sell. TJ is a very well-run company and does well in a slow growth economy.
Hey, Art, I gotta point out, CBS and News Corp make your buy list, and I mention it because just yesterday Goldman lowered Viacom. They were one of our street fighters, as a matter of fact, because they said advertising revenue is too uncertain in this environment. Why do you like News Corp and CBS?
News Corp, fortunately or unfortunately, was not able to buy B Sky B, right? So they're sitting on a pile of cash. What have they been doing with it? They've been buying back their own shares. If you look at the cash that they throw off, they're a market leader as a publicly traded media company. They can buy back a third of their outstanding shares in the next 2 years just with the cash that they have on hand. So what they've aggressively done is take down their share count while they're fighting things in the headline news. Very well-run company. They continue to grow very quickly, and I think they're going to do very well. CBS, again, this is a play on retransmission fees. It's not just the ad revenue growth, but retransmission fees, which is what we're going to be focusing on in 2012. CBS has got a lot of opportunity there.
Do you guys have any comments on the advertising market in general?
Well, we do. I think that, the ad market, as we look at advertising in print media, certainly has plateaued and fallen off a little bit. But in these online media, we're seeing an explosion of opportunities there and a huge gain in traction in broadcast media. We continue to think this is going to be a great year. Think about the fact that we're not only going to have an election, but the election cycle is starting a lot earlier than it ever has before. So we're in a presidential election cycle. That throws ad dollars out there. We got a football season. That certainly helps us. So I think as you look at broadcast media, we're going to certainly do well. I don't think we're going to see much pullback there. The areas that we're concerned about in media and ad spending is outdoor and print.
All right, hold it right there. We're going to bring in Ira Epstein, managing director of the Ira Epstein division of the Linn Group. He's been in the trading business for more than 40 years. Ira, great to see you. I want you to help us connect the dots with what happened in stocks today and what happened in commodities, particularly when we're in risk-on days. Typically, we've seen gold sort of trade off, but not today.
Well, gold did go up today, and it was interesting because the dollar went down so much. It was a day of the headlines again where Europe is getting a lifeline. Many of us think maybe they're going to save something in Greece. Yet I just read on your news banner that the EU is doing bank stress tests again, and that tells me that they're getting ready for something one way or the other. So this is all emotion. You are not dealing in a market of reality. You are dealing in a market right now in the futures markets, as I see it, of emotion. And if the headline comes out that Greece is okay or going to get a lifeline, going to get a next tranche of money, then the market rallies. The moment you hear they're not, the markets sell off and sell off in a big way. It's purely emotional right now.
Now, when you say you see that banner that the EU is preparing the banks for stress tests again, why does that mean that something is going to happen? And I guess in your view, what would be the high probability event based on that announcement?
One thing. The reason they're doing the test is something's going to happen. Otherwise, there's no reason to do it. They've done enough recently. But now that they're getting themselves ready in some manner to do a restructuring of Greek debt, and that's where I think we're headed. And I don't think it's a 21% amount. I think it's going to be closer to a 40% amount. What can the banks handle? And maybe that determines the amount. But the market's discounting Greek debt at 50%, taking a 21% haircut. Who are they fooling? Just themselves.
All right. Ira, thank you so much for joining us. We got to leave it there. That was Ira Epstein, Managing Director of the Ira Epstein division of the Linn Group. Art, a lot of debate over the haircuts, but it feels a little bit, so to speak, like we're splitting hairs at this point, right? We know it's going to be big.
Right.
Why is the market so focused on that at the moment?
Well, the market's focused on that because that's the leading edge of this sword that we're sort of looking at. What fixes European sovereign debt issues? And the biggest concern is not Greece, because Greece is a sliver of the European economy. It's the cascading exposure to Greece that the European financials have, and then by default, what U.S. financials have in terms of exposure. If we can get a concrete example of exactly how we're going to fix this problem, what it is that the ECB, the IMF, the European Commission is going to do to settle the Greek debt issue. When we know what the numbers look like, we can see what the how much is held by what institutions and what needs to be backstopped.
Right.
And I think that's what we're getting to right now. And I think that's why it's no coincidence that the Troika has held back on the latest tranche of Greek aid.
Right.
They want to hold this over their head and say, okay, I don't care if you don't like this deal. I know we said we're going to do a 21% haircut, but here's the new deal, and there's nothing you can do about it.
Right, and it sounds like they finally want a little transparency on exactly how impacted the European banks will be. Of course, it'd be interesting to know just how impacted the U.S. banks would be, but we got to leave it there. Thanks so much for joining us. Art Hogan of Lazard Capital Markets.